Over the course of this year, every famous investor you can think of has been raising the alarm on out-of-control inflation. Hedge fund legend Ray Dalio, Bitcoin king Michael Saylor, and the Big Short's Michael Burry, to name a few. And they are not alone. Consumer inflation expectations have risen for the 10th straight month in a row to the highest they have ever been. However, one investor that stands alone from the herd is contrarian investor Cathie Wood, who believes the real Black Swan event we are most likely to see is a deflationary crash. Recently, Cathie Wood was a speaker at the New York SALT conference, in which she explains again why she thinks we are heading towards a deflationary crash and why every notable investor has it wrong. In this video, we will analyze the 3 reasons why Cathie Wood believes that we are going to see deflation and show how data out from the last few months actually is backing up her claims. Make sure to stick around to the end of the video where we will cover how, besides for investing in disruptive innovation, Cathie Wood is now turning to the millennial population alongside Bitcoin and Ethereum to position herself and ARK Invest to profit from the entire situation. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
When all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world.
What? Bro, what are you talking about, man?
And we see 3 sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up, and artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another, explosive energy, incredible deflation. That's the first deflation.
While the rest of the world thinks, I mean, if you were here for part of the day, everybody's talking about inflation.
Oh, and that's what I love. You know, if the whole world thinks that's going to happen, and a portfolio manager and analyst team thinks that's going to happen, well, if we're wrong, it's not going to matter that much, right? Because nobody's expecting it. It's not in the market. But if we're right, the returns are enormous. And I think that's what's going on with the technologically enabled innovation that we see, especially in healthcare, by the way. But there are 2 other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have Wrights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the 3rd source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other 2, but this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushed back on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. Because
There's a chip shortage.
I do believe there's a chip shortage because the world's going digital. But I believe.
But wouldn't that be inflationary?
Well, I believe chips are the new commodities. That's the point I'm making here. So chips are going to be what Dr. Copper has been in the industrial world. This is Dr. Digital, I don't know, in the form of chips. But you hear the auto industry screaming. You know, auto sales have dropped from 18.5 million units in April to 13 million. Now, these are annualized rates in August. That's more than a chips shortage. What happened last year is People bought the cars. They're in their driveways, garages, didn't want to take mass transit. And now there's a decision. What do I want to buy? A gas-powered car or an electric vehicle? Well, that's where the short supply is. And I think the excess supply is going to be in the gas-powered side. So this is a really important test case of why I formed the firm when we did. I think the disruption is happening to the auto industry now. If you're looking at the traditional benchmarks, they may very well be right. All I know is when we are looking at the transformative growth that's going to take place in our space, and we're completely devoted to nothing else but disruptive innovation, we see explosive growth. I think one of the reasons they will look right in terms of GDP is if the other side of disruptive innovation is creative destruction, well, what's happening? It's the industrial world evolving into the digital world as more of the physical world goes digital.
Right.
Transportation, importantly, right? And so the traditional benchmarks, GDP, the statistics that we look like are probably going to look pretty lousy at times, I would say.
So there are the 3 reasons why Cathie Wood expects a wave of deflation and not inflation. And if you are a believer in Wrights law and the inevitable exponential nature of innovation, Cathie does have a strong argument. Some data out over the last few months does suggest that ARK Invest's deflation thesis could be unfolding in front of us. The first is lumber prices. After seeing a huge spike in response to COVID-induced money printing, we have now seen just under a 70% fall in lumber prices since its peak a few months ago. Another piece of data that Cathie pointed out is the cost of innovation is getting exponentially cheaper. For example, the training cost of AI. Training costs for artificial intelligence has declined by a factor of 10 yearly since 2017, and this is expected to continue to fall by 68% per year into the future. So let's say Cathie and her firm at ARK are correct in their deflation bet. How are they positioning themselves to capitalize on it outside of investing in disruptive innovation? Well, later on in the interview, Cathie explains her tactics, and it all comes down to following the millennial money as well as investing in Bitcoin and Ethereum. As we have covered in the past on the channel, millennials are the largest generation, and as they move into the peak spending years of their lives, they are going to radically change the investing landscape.
We just learned from Jolene Caruso that millennials are 70 million strong in our economy and now bigger than the baby boomers as a demographic. And I'm going to harken back to Stan Salvigson. Most of you won't remember who he was. He made one very important call in the early 80s. He said, baby boomers are going to be the reason that the equity market goes up for the next 20 years. It was a brilliant call. He's no longer with us. We're in the echo now. And I do believe that both crypto and the equity markets are going to be powered by millennials. In fact, Tom Lee, he has done the arithmetic the way that Stan did. And I think he says this bull market will not end at least until 2026, and maybe not until 2038 when the number of millennials peaks out there. Well, I went through it in the 80s and 90s, and nobody believed him, thought it was a ridiculously simple call, but when you look back in history, it was a pretty good call.
If you could own Bitcoin, Ethereum, or some other crypto currency, and you could only own one, which would it be?
That is becoming a harder and harder question to answer. I think I'd default still to Bitcoin because countries are now deeming it legal tender, and we haven't even put that into our thinking. Ether, however, is seeing an explosion in developer activity thanks to NFTs and DeFi. I'm fascinated with what's going on in DeFi, which is collapsing the cost of the infrastructure for financial services in a way that I know that the traditional financial industry does not appreciate right now. So it does have to move from proof of work to proof of stake. That transition is underway and seems to be taking hold. So our here's how I'll answer that question. Our confidence in Ether has gone up dramatically as we've seen the beginning of this transition from proof of work to proof of stake. We'd still probably do 60% Bitcoin, 40% Ether. If we're right and companies continue to diversify their cash into something like Bitcoin, and institutional investors start allocating 5% of their funds towards, I'll just say Bitcoin for right now, because we framed it for Bitcoin, could be for other cryptos as well. We believe that the price will be tenfold of where it is today. So instead of 45,000, over 500,000.
So the 3 ways Cathie is looking to profit off the situation: invest in disruptive innovation, follow the millennial money, and finally, invest in cryptocurrencies such as Bitcoin and Ethereum. Do you think Cathie and her firm at ARK are correct, or do you think the money printing is so out of hand that inflation is inevitable? Let me know in the comments. Now finally, what type of investing timeline does ARK expect this to all play out in? The majority of investors have a 1-year investment time horizon, but Cathie and ARK disagree. Here is Cathie on the timeline that they invest in, but before that, today's video is brought to you by the channel sponsor, BlockFi, the leading provider of financial products and services for crypto investors. At BlockFi, you can put your crypto to work, earning up to 5% interest on Bitcoin and Ethereum and 10% APY on stablecoins. If you are a crypto holder like me, you may as well be putting your holdings to work and earning passive interest on your stack. BlockFi is backed by some of the biggest names in the industry, such as the Winklevoss twins and Coinbase Ventures. BlockFi has also recently released their BlockFi Bitcoin Rewards credit card, where you can earn 3.5% back in Bitcoin for all purchases in the first 30 days and then 1.5% thereafter. They also recently ditched their annual fee, and there are no fees to use the card. To start putting your cryptocurrency to work and earning interest, and also earn up to a $250 crypto bonus with a deposit of $100 or more, go ahead and check out the referral link in the description right down below.
In terms of our investment time horizon, 5 years. So we have to believe that one of the technologies, the 14 technologies around which we have based all of our research, is going to inflect within 5 years, or at least be discounted in the start to be discounted in the market as though it is about to inflect. So 5-year investment time horizon, our minimum hurdle rate of return is 15% at a compound annual rate over 5 years. And so I think that that combination of 5 years plus exponential growth trajectories is what is finally starting to get into the market. I've been waiting for years.